Buying is easy. Selling, that's the hard part. Whether your stock is up or down, deciding when to sell can make or break your returns. Let's talk about how to do it better. Hi everyone, welcome back to Intelligent Investing Market Talk series with me, April Lee Tan. Today we'll be talking about one of the most important and often emotional decisions every investor faces: when to sell stocks. To help us unpack this, I'm joined by Edmund Lee, a CFA charter holder, market practitioner, and a fundamental analyst who also uses technicals in trading Philippine and global markets. Okay, thank you, Edmund, for joining us today.
Well, good. Thank you for inviting me.
Okay, so today's topic is, I think, interesting and a bit controversial. So, how, when to sell stock. So, anyway, so investors often obsess about when to buy, how to buy, but selling seems to be even harder, whether or not the investment is profitable or losing money. So, why do you think it is difficult to make a selling decision?
And I agree 100% with that statement. It's because when you're buying a stock, there's just one emotion that gets involved, right? And it's hope and optimism. Because you buy stocks for one reason, which is to make money. But when it comes to selling, there's always that judgment call that needs to be made. So when you're making money, do you sell? In the event that you do sell, it goes up some more. Mainis ka naman. And then if the stock is down and you think there might be a change in narrative, should you sell? Right? And little did you know that if you don't sell, the business continues to deteriorate and
Yeah.
it snowballs, and in fact you lose even more down the road. So I 100% agree. Selling is always the most difficult part when it comes to investing and trading, right? Because there's always going to be plenty of question marks about top slicing. How much do I sell? Should I even sell everything, or should I even sell at all?
Yeah, and you could make the wrong decision, right? Like you could actually sell and then the stock could go up also, right? So then
And
you
just to like put this in analogy, we always call it the feedback is always ambiguous. So in regards to any competition, you know what the ending result is, and it's
Yeah.
usually a positive, right? Here, you could have a positive remark, but it could be the wrong decision because the stock continues to go up. Or you could have a negative feedback, which is you lost, but you could have been positive because you could have saved so much more by selling at today's price.
Yeah,
So that's always the controversy with regards to selling.
okay, so yeah, another, I guess, controversial topic. So selling at a loss, is that something that people should learn how to do?
Of course, I think it is. So especially if you're from an investing standpoint, right? And when narratives and the business and business fundamentals start to change and start to deteriorate, there's always that early warning signs. Things, people say that it often starts slowly and then all at once,
Yeah,
right? But the thing is that starting slowly, usually there are already warning signs, right? And you could say, for example, like the property market, there's already been warning signs
yeah.
about occupancy before earnings start to get hit. And I really believe that from an investment standpoint, you have to have that flexibility to also understand when your thesis is starting to become wrong. And when that thing starts to turn into a negative or changes in thesis, you also have to accept it and also have to move on. And that's the reason why we also talk about diversification and asset allocation as well.
Yeah, yeah. Okay, so I guess if you're a fundamentalist, knowing why you bought it and if that reason has changed, being flexible to, sell it, even if it is at a loss, right?
That's also the reason why one of the most famous investors, Peter Lynch, right, also talks about you don't need to be right 100% of the time.
Yeah, yeah,
Right?
yeah.
In fact, if you're right 30% of the time, that's usually our benchmark. It should be more than enough. Except that you must have that open mindedness to accept that when things change, you have to have that ability to move on and
Yeah, cut your
cut your
losses.
losses
Yeah.
already.
Okay. So is there such a thing as, because I mean, there are some clients, no, who I guess fall in love with the stock. Like they have like their favorites. Let's say, for example, I think our clients in COL love Jollibee, and then they'll just hold on to it. So is that also like a pitfall, like falling in love with a stock and saying, no, it's like, this is really a long-term investment.
No, and I agree with that statement. If you're a long-term investor, like what we talked about in the thesis, for example, like Jollibee. To be fair to Jollibee, you're in and you're out, continues to grow.
Yes.
And I think for the past 15 years, since 2010, they've probably been growing at 10 to 12% per year. So with regards to Jollibee and that segment, you're buying a company that continues to grow. The question that you should ask yourself in the next 5, 10 years, will it continue to grow?
Yeah.
And if it checks all the boxes there, then by all means,
Yeah,
in my
continue.
opinion, you can continue to hold on to that stock, right? The biggest question mark comes when there's that pivot that we always see, where what's going to happen in the next 5 to 10 years. And when that starts to change, which is not an
Yeah.
easy thing to spot also, but sometimes at the very early pivots, it's already telling you there are warning signs.
Yeah.
And those are the ones that become a concern. And case in point, like what I always talk about the last few years, unfortunately has always been about the property market,
Yeah.
because there are already warning signs a few years ago, and that continues to plague the property market up until today.
I'd like to ask you, how you determine the price at which you're going to sell. So let's begin with active investors, like active traders. Is it important for traders to have a clear sell plan before they even buy a stock?
Of course. So I tell, this is on the short-term trading side, right? Even when you're selling, there has to be a level of expectation. So what do I mean? You should have your target prices already intact, meaning if you're looking at 2R or twice the risk that you're putting in, or 3 times R, right? That's the first step. So knowing when you're going to be selling, if it hits your target, what your plan is, meaning if you're planning to sell half, sell 1/3, and then trail the balance, right? That's one way that we look at it. At the same time, let's say if it doesn't go up, you should know when to be exiting. And so for many times, we use our stop losses at break of support. And that's usually a moving average or a below a particular range.
So how do you determine the selling prices, technicals?
Again, it's case to case. So it depends. So usually we use it in combination with fundamentals as well. So if we think, for example, like stocks are pretty much fairly valued, but they are still in play. Then usually we use 1R, 2R targets. So meaning 2R is twice the amount of risk that we are inputting. Now, for example, case in point where we really, really like the stock and we think there is still more upside potential, then sometimes we will stretch that to as high as 4R and then use that as the initial selling point and then try to hold it as much as we can.
I see. But of course, it's not only on the upside, but on the downside, like you said, like a potential cut if, it doesn't go up.
Yes, that is correct.
Yeah. Okay, so now I'd like to ask you about fundamental investors. How should they sell? Should they look at the target price based on, say, what an analyst comes out with, or should they just stick to the investment thesis? I mean, if it's still okay, still the same, then stay invested in the stock.
No, definitely. I think you need both. So the first part is about target prices in analyst reports, right? So it gives you an idea as to where your initial targets would be, right? But apart from that, I think the investment thesis is even more important. And especially if you're stuck with something that continues to grow and is probably stuck in a major mega trend, right? And the reason why I share that is because as years go by, companies have what we call a re-rating, right? And as the company continues to grow, even your target prices grow every single year. And that's the benefit for buying companies that are in sectors that are growing, because it provides you that margin of safety as well, right? So what do I mean is, if you buy a company that is cheap, but it's not in a growing sector, sometimes it can just stay here, because what's next? How do you get your upside, right? It's very different from buying something that is slightly fairly valued, but the industry as a whole is growing, right? And one example that we've seen was with the mining sector the last couple of years, right? Maybe even just last year. Um, and like what we've seen with Apex, Apex went from a 600 million profit a quarter. Last quarter, they did 1.7 billion, right? And I'm sure gold prices at $4,000 per ounce, they'll also continue to make even more money, right? So for me, the question is, what's your viewpoint on gold, right? Is it something that you will continue to climb in the next few years? And if that answer is a yes, then maybe you could still be holding that particular industry, right? So that's one way how we look at it. And I think it's really a combination of both. Have your initial target prices and also understand that industries that are continuing to grow continue to outperform in the medium term as well.
Like the target price can still go up.
Yes, that is correct.
Yeah, so it's not that simple. Let's see. So for example, in the Philippine market, I mean, in general, let's not talk about Apex, for example. Valuations can stay cheap for a very long time, and we all know that. How do you decide when cheap is no longer good enough to hold a stock?
When it's a great question also. And cheap only becomes a concern to me when earnings start to decline. So if I'm buying, for example, like, and you'll see this with many consumer companies, right? Most of the earnings are maybe flattish to single digit growth. And that to me is an okay sign, right? So people are advocating that it's cheap, but it's not growing. But for me, it's just a matter of time in that instance. That's the reason why I continue to like the consumer sector. Plus the fact that you're getting paid a yield, which
Cash dividend.
I've never seen a yield happen in consumer stocks in the last 15 years. We're seeing yield actually happen in consumer stocks today, right? So it's like buying a coupon for these consumer companies. Now, to answer your question, when it becomes a concern is when really earnings are starting to decline. And
maybe it's more structural, or the decline.
Exactly, right? Unfortunately, we keep on going back to the property market because we've seen some impact happen, whether it's in subsectors, construction, hardware, etc. And we've seen that happen in some parts of the property because of the slowdown that's been happening the past few years, especially because of high interest rates. That part now becomes a concern for me, right? So when I'm buying stocks that are cheap, but there is question about, again, earnings declining, then that usually tells me to step aside first and reevaluate the situation, or at the very least, reevaluate the situation, right? And I think that everybody should continue to question the sector that the company that you're buying at is in.
Okay. What about cash dividends? Does it affect your decision to hold the stock or to sell it?
Oh, definitely. So that's the reason why we continue to like consumer companies. This goes on even for the utilities. We've seen water and electricity be one of the biggest outperformers the past few years. And Manila Water till today, I think, still pays out 6.5%, 7% cash dividend at today's price. You could make the case that, what about the telcos? Because the telcos have been in a decline, right, this year. But I tell people, I understand also because average revenue per user has been on the decline, right? So is it really something safe? And I tell also people, well, I know at the end of the day, most people would cut what you eat rather than cut your internet spending. And so for me, it's just a matter of time. And at today's level where, for example, PLDT is paying out 8.8 to 9% cash dividend, for me, these are no-brainer for investors.
Yeah. I think another stock that's kind of like that would be, SEC, DMC. I mean, but if you add back all the cash dividends that they gave, then,
it's well worth it.
It is worth it. Yeah. It's just interesting. Anyway. So I know that you use both fundamentals and technicals. So what's your process when the fundamentals look good, but the chart's breaking down? Do you still buy it?
First thing I do is accept. What do I mean? Is when prices are not going the way you want it, the first thing I always tell people is accept it, meaning understand why the market doesn't like it. And that has happened many
Yeah.
times in our career, right? Whenever stocks are breaking down, sometimes you don't know.
Yeah, yeah, yeah.
I mean,
So price action,
so
very
for
important.
price action is very important for me because I always tell people learn to accept why it's down first, and then you start to think whether is it something you agree on, something you disagree on, right? But don't let the love for the stock make you also fall in love with the
Yeah, yeah,
company,
yeah.
right? So that's the challenge
Yeah.
that most investors and traders face.
So I guess what you mean is, for example, if it's going down because, say, for example, it's going to be removed from the index, then that's fine. You don't have to be worried. But if it's going down, like you like it, but something could be wrong with it, not just like being removed from the index, then you have to think twice on whether you're still gonna keep that stock, right?
That is correct. I mean, we classify drops under three categories. So we usually classify it whether it's market driven, event driven, or fundamental driven. And usually, if it's like in the case of index rebalancing, it's event driven sell off. For us, we like it. We
Yeah.
view that as an opportunity, right? If it's falling, and then sometimes it's because of the third one, which is a fundamental problem, ayan, may problema tayo,
Yeah, 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 yeah.
right? So that's when we have to reevaluate and think about selling our position.
Now I'd like to ask you the opposite situation where a stock is breaking out, but fundamentals are bad. Do you buy those kinds of stocks? And if you do, like, how do you exit? Like, how do you determine your selling price?
Um, so first of all, I'd never buy something that I do not know what is happening. Has there been an instance where some stocks are going up because of maybe short squeeze or some speculation that's been happening, and you're seeing a spillover, for example, right, from the top gainers and it's going to them? Usually, I don't participate in those issues. So for me, the very basic is know what you're buying. Right? Not everything needs to be bought, and I think that is very important for investors and traders because the moment that you buy something without knowing and you get caught in that hype and speculation, the feedback can be very painful and the losses can mount. So that for me is the base case for any investor or trader.
Yeah, but I guess if an investor buys that stock, they have to be really strict about following technicals. Yeah. What are the most common mistakes investors make when selling?
I think one of the most common investors people make is, especially from investors, is falling in love with the stock, number one, which we talked about a while ago. Mainly because when the business is already changing and because you're afraid to lose and it snowballs into something even bigger, that is one of the most common pitfalls that we've seen with investors. And it's very easy to blame the company for not delivering on that performance, but nobody asks you to buy also, right? Again, there's no crying in the casino. And that's the reason why it's also on the second point is one of the biggest, personally, one of the biggest flaws also is selling winners very early as well, right? Because when the investment is there and the thesis is still intact, that's my point a while ago where you should try to hold it as much as you can, right? I understand might be initial selling targets for you, especially once it starts reaching target prices. But once that sector continues to grow and outperform, also expect re-ratings to happen in target prices. So that for me is one and two.
I see. So I'm just curious. I mean, what can you tell investors? I guess so that they don't get picon if they sell too early. Like, what's your advice to them? Or if they're conversely selling at a loss, what can you tell them so that they don't feel bad naman?
That's a great question. And that's the reason why both up and down, we always talk about the selling half. And I think selling half is incredibly important because when you're losing and you're not sure, sell half first. Especially when the thesis is changing, sell half first. And the reason why, it's because the balance and the half that you have, you will make a rational decision next. And what do I mean? It's because if the business continues to deteriorate, you won't mind selling everything. Why? Because you already sold a portion
Yeah.
at a higher price, right? Inversely, if you're making money and it's hit your initial target price, right? And you're afraid of losing those gains, also sell half. And then let the balance, try to hold it as much as you can. Because if it goes down, for example, at least you sold half. And if the business is still there, you can still buy back, right? And on the flip side, if you sell half and it continues to go higher, at least may kalahati ka pa.
Yeah, so that's a good risk management strategy. And as you said a while ago, I think in the very start, the importance of diversification. At least if this is a mistake, then the others can make up for it. Yeah. So you said maybe 30% of what you buy makes money, then the 70% doesn't. Then at least you're still fine, right?
Yep, I agree.
Yeah. Okay. So, for you personally, have you ever encountered or you experienced times when you sold too early or too late?
Sounds like a normal day in the office.
So, what did you learn from those mistakes?
So, our investment philosophy is really top down. So, before we look at companies, we look at where the mega trends are globally, right? So you could have, especially today, you could have the AI story. Right? Before, we've seen it with smartphones, with EVs, and there was always gonna come a level of skepticism. Right? And I remember clearly because we were buying Tesla at $40 per share. Right? And we sold it, well, I sold it at $55 per share a month later. Prior to the stock split, that went up to as high as $2,000 per share.
Yeah.
Because
That was really early.
because you were very skeptic of whether EV could turn into something profitable. Why? Because the battery cost back then, I remember, was probably close to $1,000 per kilowatt hour. Today, you're sitting at sub $100, maybe $70 per kilowatt hour for the cost of the battery. And they've made it into something that's very expensive. And now you're seeing EV cars being sold in China today cheaper than most of your combustion cars alternative, right? So nobody really believed it at the time. It did happen. So I always tell myself, when you're buying these mega trends, right, there's always going to be hiccups at the very beginning. And it's hard to stick with that thesis, I'll be honest, right? Because you'll always start to question when things are going south. But it's very important that you have a strong foundation. So like today, the biggest mega trend today is AI. And it's been maybe 2 to 3 years since that AI. Until today, you're seeing huge level of skepticism on people thinking about how much productivity growth will we see with AI. I think we're still in the very early stages. And I really do believe that any drop that we see, you should be looking for ways to participate in that AI megatrend.
Yeah. So I guess aside from your advice earlier to maybe sell half and diversify, maybe a good advice also for investors is to control your size. Like maybe if you had bought just enough Tesla,
I agree also.
you would have held it all the way, or you could have had the stomach to hold it. But if you go all in, then I guess the tolerance, the risk tolerance would be different.
Yes, I agree also. Because if you're betting a large portion in something that is still early and uncertain, you will always go through the difficulty of holding it throughout the entire megatrend, right?
Yeah. Okay. So that's interesting. So anyway, for my last question, if you were to summarize your sell framework in a few simple rules, what would those be?
I guess number one would always be know what you're buying. And that is risk number one. The moment that you buy something and you don't know what you're buying, you're already putting yourself in a difficult situation. Why? Because you're going to get jittery, you're going to get make irrational decision, or even worse, an emotional decision. So that for me is number one, know what you're buying. Number two is be diversified enough that you have a good position sizing in what you're buying. And number three, for me, is especially in the Philippines, is buy yield. Because yield will buy you time. So this might not be applicable when you're buying US companies because most US companies don't have high yield. But for the Philippines, buy yield because it will buy you time, especially when you're buying something as cheap as where we are today.
Yeah, okay. So with that, thank you very much, Edmund, for your time and your insights on when to sell, and how to manage your risk, when buying these stocks.
Thank you. Thanks, April.
Okay, thank you. Selling isn't just about locking in gains or cutting losses. It's about having a clear, disciplined framework where you rely on fundamentals, technicals, or both. To our viewers, I hope this episode helps you approach selling with more confidence and structure. If you found this helpful, don't forget to like, subscribe, and share this video with your fellow investors. I'm April Tan, reminding you to be smart, be selective, and as always, invest intelligently.